Hello, and welcome to the Lend Hoping Nothing podcast. I'm Michael Humphreys, and I'm happy to be talking to you today. This is episode 12, and today I want to talk about investments, and particularly investing for the sake of retirement, because this is probably where most of us are going to be most involved in investing in some way. And so, um, the first kind of thing is I want to focus on some of the facts and information about investing, because in the Catholic internet or blogosphere or Twitter sphere, there seems to be a lot of misinformation or misunderstanding or confusion about just the mere facts. After kind of talking about that, I want to kind of start looking into what is the morality of investing, especially for retirement. And so we'll kind of get into what are the type of considerations that we should take into account when we do this, and what are some of our options. So first kind of caveat, though, is that I'm not a financial advisor. I'm not a tax advisor. So take what I have with a grain of salt. Do your own research. Look out for professionals to kind of help you make these decisions. So, kind of getting into just some of the facts of things is that let's consider just what are our options for investing. And so, typically, the main one that people are going to use is a 401k, and this is a employee-sponsored retirement account, or employer-sponsored retirement account. And so typically this is going to allow you to invest a portion of your salary or wages into an account. And usually this is going to involve an employer match of some kind, usually between like 3 and 5%. So if you put in 3% of your income, and say that's like $500, then the employer will match that $500, so that you have $1,000 in the account. Now, if you put in 6%, so you put in $1,000, they may match only up to that first 3% or that first $500. So typically, though, in these type of accounts, you'll usually only have a small set of options, typically mutual funds to invest in. So usually it'll be a set of like money market, bond funds, stock funds, maybe some mix, maybe some age-dependent funds, and so forth. But usually it's just a small set of funds that you can invest in. Now, going a step away from the employer, you could open a IRA, which is individual retirement account. So instead of being sponsored by your employer, you as an individual can open an account with a bank or a brokerage. And typically that's going to allow you to also invest your money. You won't get that employer match, but it'll usually open up the sphere of what type of investments you can get into. So not just a small set of mutual funds, but maybe the universe of mutual funds. And then also stocks and bonds, and even more dangerous things like options. And so it gives you a much broader spectrum to invest in, but it does kind of, you don't get that employer match. So here then we need to talk about two types of these accounts, and they're really based on sort of the tax advantages. So a traditional IRA or 401k is going to allow you to deposit money pre-tax, so you're not counting that money against your income, and you're not paying income tax now. And so you're allowed to put it into the account and invest it in whatever investments are available to you. And then it's able to grow. But when you withdraw it, when you make that withdrawal, then it starts to count against your income and you pay income tax against it. So there's a certain tax advantage there. And the idea is typically In retirement age, your income bracket is going to be lower than in your working age. And so you can end up paying less in income tax by depositing this money pre-tax and then paying taxes in retirement. There's some disadvantages there potentially because you have to be careful about how much you take out, and because that could potentially increase your income too high and so forth. So there is typically the idea there is that you'd use this as sort of paying for your sort of regular monthly expenses, so groceries and gas and so forth. Whereas on the other hand, there is the Roth account. And what the Roth account is that you deposit the money after paying income tax. But after that, you don't pay income tax on it again. So you put the money in, it grows, and then you can withdraw not only the money that you put in, but also that investment growth without it coming into your income tax. And so then this allows you to have that not impact your income taxes in retirement. And some of the advantages there might be you may have a big expense in retirement that you need to pay for. And so something like your water heater breaks and you need to get the money to repair that or buy a new one, and you can withdraw that money without having it impact your taxes. So there's some tax advantages there. However, there's also some limitations and restrictions. So there's certain eligibility requirements. So if you make too much money, you can't deposit, and it's kind of graded. So as your income is higher, you can't deposit nearly as much. And then there's also some restrictions around when you can withdraw and how much. So there is a limit, I think it's around 60, where you can't start withdrawing for retirement without paying not only taxes but penalties. And so there's some penalties there if you withdraw too early. And then also there is some minimum required distribution levels in retirement. So you have to take out so much in retirement as a minimum. So you can't just leave it in there forever or until you die. So yeah, there are some restrictions around that, but there's also the tax advantages as well. So it's a way of kind of encouraging people to invest for retirement. So these tax advantages, but it's also those restrictions kind of prevent people from misusing these and not actually saving for retirement, but trying to get tax advantages to just grow their money for other reasons. So the other option would be kind of like just opening up a brokerage account. So you open up an account where you just buy and sell securities. And so this is going to be much more freeform, much more open, because you don't have all those restrictions and requirements and eligibility that you have in those sort of retirement accounts. But it also means that you kind of lose some of that, some of those tax advantages as well. Because typically buying and selling securities, you're going to pay capital gains tax. You may be paying taxes on dividends or bond payments as well. And so there's a little bit more, while it has less restrictions, it also has less advantages. So that's another potential options to invest in that. Now, in saving for retirement, generally, I mean, you could buy CDs or short-term treasuries or even just a savings account. But here I'm kind of trying to focus on discussing sort of investments for retirement. So having discussed the types of accounts that you could open for retirement, let's kind of talk about what are the sorts of things that you could invest in. And so the main one is going to be, or at least the one that's most popular, most well known, is going to be stocks. And stocks are an ownership claim in a company, which include a set of rights and entitlements to the company. So you have a right to vote in the annual meetings and make proposals for the company. You have a right to vote for the board of directors. You have certain rights to, if the company needs to be liquidated because of default, or maybe the company decides to go private, you have certain rights as to how much you receive for that after debts are paid. And then also you have a certain right to dividends if there's being paid. And typically those dividends are paid on a per share basis. And so that's one way that you can also make money, not only buying and selling that ownership claim, but also off the dividends. And I've seen dividends as high as 9%, but typically they're lower because companies are not focused merely on paying out the profits. They also want to grow the value of the company. So that's one potential option. And then we'll get into some of the morality of that later. The other one is going to be bonds, and these are debt obligations. And as I've argued before, bonds are not usurious because they are secured by assets rather than people's promises. And so ultimately, kind of what's going on here is that typically the most simple example is going to be that a company will issue a bond with a particular what's called face amount associated with it. So say $1,000. And so when they issue that bond, you will pay $1,000 to the company to buy that bond, and then they will agree to pay you what's called a coupon, which is just a regular payment, whether it's monthly, quarterly, annually, whatever. And so they'll pay you that over time for a certain number of years, and at the end of that time, you'll receive back that $1,000. So for example, if you buy a $1,000 bond with a 5% coupon paid annually, you will receive for 10 years. Over those 10 years, you'll receive $50 each year. And then at the end of that 10th year, you'll receive the $1,000. Now, there's also the possibility that you could buy bonds that have already been issued and buy them from other investors. And there's some other thought that goes into that about the value of those bonds and things, but that is another option. But these are very different from stocks, obviously. So there's no voting rights. You do have certain rights to the company if it defaults or needs to be liquidated, because you're a debt holder. You're going to receive the liquidation value sooner, because the idea is that the owners have to pay off their debts before they can receive the rest of the value. And then there's like senior bonds and junior bonds. The seniors will be paid first before the juniors, and so forth. So there's a little bit of complication in there, but basically you have certain rights to receive these annual payments, which are coming from the company. And then you also have rights to recovery of your principal in the case of default. So very different from stocks, and morally very different, as we'll see. So the next one is going to be mutual funds. And here, mutual funds represent a whole range of different investments, because there are stock mutual funds, there's bond mutual funds, there's mixed funds, there's active, passive, and so forth. So the thing to realize at least as we kind of go into the morality section, is that when you invest in a mutual fund, you're actually investing in that company. The mutual fund is a company that invests in other companies. So you never actually own the underlying securities. So if you invest in a mutual fund that's invested in the S&P 500, you never actually own any of the stocks of those companies. What you own is a share in the mutual fund. And that's a very important distinction, and it's something that has been very confused by a lot of people that I've been listening to recently. So you have no voting rights in those companies. You may have certain rights to the mutual fund and potentially driving change in the mutual fund, but you don't have rights in the underlying companies. And the same holds true for bond funds and so forth. So you can't go up to the fund manager and say, okay, well I'm withdrawing from this. Please give me my stocks. I don't want to be a part of this mutual fund anymore. No, what you own is a share in the company, and when you withdraw, they'll give you the NAV. It's like the net account value. So it's the actual value you own in that company, and they'll pay it out to you. And they may or may not have to sell any securities to even give you that value back in cash. So some mutual funds, though, are starting to get the mutual fund account holders like voting rights, because the fund managers are the ones who actually manage the voting rights, and so would be involved in those annual meetings and so forth. So there's some things going on there as well, which is kind of interesting. So those are kind of the main type of things. There's plenty of more complicated things that you could invest in, like options. That's a whole different area, but those are typically much more risky and really require much more sophistication to invest in wisely. The thing I would really impress on people is that the range of investments is also like very large. Like we'll typically hear about, Apple and Tesla and Google and so forth, but there's tens of thousands of publicly traded companies, and they're not all involved in morally illicit things, and not just stocks but also bonds. So there's a whole range of different investments out there. And that kind of brings us into starting to discuss the morality question. And so the first thing to consider is that investment is not merely a moral act, or not merely a technical act, but a moral act. And this is from John Paul and Benedict and so forth. So we need to not only consider our returns, but also consider the morality of what we're doing, because these are human acts we're doing, and so they have some sort of morality associated with them. So the first sort of question that we need to ask is, well, should we save for retirement in the first place? And I think it's very clearly yes, because we should be. It's like preparing for any sort of future event and planning for it. So you buy extra groceries for the coming week because you're going to need them. You don't go and buy them as you need them. You go and you buy them, ahead of time and store them and so forth. So it's really just part of a prudential consideration of what you ought to do and ought to prepare for in the future. I mean, like if you have a big expense that is coming up, so you're going to have to replace your roof in a couple of years. You're going to save up for that. So it seems like saving up for retirement is the same sort of consideration. And so there's a lot of benefits to this as well. So uh, saving up for your retirement, that's going to allow you to be more secure and confident about your future today, which is going to allow you to be more confident and secure in being more generous today. So you don't have to necessarily worry about, well, how am I going to pay for things in the future? So taking care of that is going to allow you to be like, okay, well, I have a plan, and I have this set, and I have my expenses more or less kind of settled so that you can be generous in the future. And there are ways where you could save for retirement in the wrong way. So you just want to have a lot of money. A lot of people will say, well, I don't want to be a burden on my children in the future. And so they want to just be able to hire everyone to take care of them. So that may not be the best idea either. But also the consideration is that saving for retirement could allow you to live closer to your children, to be more involved in their lives, rather than not having enough and having to potentially rely on them as they're trying to develop their family, and bring all those expenses when they're just trying to get started. So having that retirement fund is not only going to be able to help you pay for your expenses, but also potentially helping them. So it's not something where you can just be generous today, but it's potentially being generous in the future as well, and sort of mixing that Roth and traditional accounts might be able to help you. So your family needs, or your children need to fix their car because it broke down, or they just had a baby and they're trying to figure out how to pay the hospital expenses. And so it gives you some more options on how to support yourself and your future family. So there are good reasons to save, and there's good things that you can do with it. So yes, retirement, I think, is a good thing to save for, and saving to cover those expenses, and not merely relying on other people to take care of you. Now, hopefully you are going to be involved in your children's lives, and that's all beautiful, and that's something we should work for. And saving for retirement could help you get into that place, and potentially working that out with your children, like beforehand, like talking with them and being like, you were approaching retirement, we have some money saved up, I want to be closer to you guys, let's be more involved in each other's lives, and so forth. So but then we come to some other moral considerations. And so the first thing to consider is that because there is such a wide range of companies to invest in, there's usually not a need to invest in a company that is explicitly, openly, clearly committed to some grave evil. Like, given the tens of thousands of companies out there, there's no reason that you have to invest in Google or Microsoft or Apple or any of these other companies that might be doing, really gravely illicit things. So it's not necessary. Now, given particular circumstances, so for example, the only thing you have available is like a 401k for whatever reason, maybe you don't have any other options other than to invest in a mutual fund that's going to include some of these companies. So what are the type of moral considerations that we need to take into account when thinking about whether we're investing in companies or even indirectly through a mutual fund? What are the type of considerations that we should make? So we need to first make use of moral principles and not merely moral slogans. And the two moral principles here that we are going to take into account are legitimate cooperation with evil, and then principle of double effect. So let's briefly talk about that. And so this book I've been reading, Market Complicity and Christian Ethics, written by a Dominican, has been really good. And he starts off with making this point that we need to consider moral principles first. So now, legitimate cooperation of evil. So, sometimes in society we cooperate with evil, and so what are the considerations of when that can happen? So, what are the criteria? And here he lays out 3 criteria. So, 1, the cooperator, so the person who's cooperating with the person doing the evil thing. The cooperator's act must not be evil in itself. So, like, the person who's stealing something, like, you can't steal with them. And so it can't be evil in itself. So, buying and selling stocks, as I've argued, is not evil in itself. Buying and selling bonds, even taking the profits, not evil in itself. So the cooperator, second criteria is the cooperator is motivated by a good intention. So you can't intend the evil act. So the thief is stealing something. You don't intend his theft. So in our case, we're not intending necessarily what these companies are maybe doing that is evil. But what we're intending is to be able to prepare for retirement, to save up money for that. And so making use of this company and the profits that it's generating to achieve that end. And the third one is really the crux of the consideration. So the cooperator's reason is proportion to 1, the gravity of the perpetrator's wrongdoing, and 2, his or her proximity to the wrongdoing. So the evil that he's doing comes into consideration, but also your proximity to it. And here, typically, we're thinking about proximity in terms of like causal relations. So there's a difference causally between unlocking the door for the thief and then maybe filling up the car of the thief with gas as he goes off to go steal. So there's a difference there. Like the first one is more what's called proximate, whereas the other one is more remote. So those are kind of the 3 sort of criteria and that we need to consider. And that last one is also going to be closely related to the principle of double effect. Now, the principle of double effect is explained here. And so the principle of double effect has 3 conditions. So the act considered independently of its evil effect is not wrong in itself. So what you are doing is not evil in itself. So you buying and selling stocks and so forth, that's not evil in itself. So the agent intends the good and does not intend the evil either as an end or as a means. So here, the common example is like an ectopic pregnancy. And there's how do you deal with ectopic pregnancy? So an ectopic pregnancy, though, is one in which the fetus has implanted in the fallopian tube. And if it continues on, the fetus will eventually grow and it will burst the fallopian tube, which is life-threatening to the mother and also to the child. So how do you resolve that? Is that you actually remove that part of the fallopian tube. And so the good you intend is preserving the life of the mother, but you're not intending the death of the child. And that's a crucial distinction, because what you are not doing is the act you're choosing is not to kill a child, it is to save the mother. And then the final thing is the agent has proportionally grave reasons for acting, addressing his relevant obligations, comparing to the consequences, and considering the necessity of evil, exercising due care to eliminate or mitigate. And so the question there is it proportionate? So the evil effect that you do not attend is the death of the child, but that is proportionate to the good of saving the mother's life. And so in that sense, it meets all this criteria. But then that becomes the question with respect to investing in these companies. And those considerations depend on which type of security we're involved in. So first of all, with mutual funds, the good you're intending is being able to save up for retirement. The sort of evil is the sort of evils that these companies are involved in. And so the question then becomes, to what extent is your investing in this mutual fund going to lead to them doing those evils that you don't intend? And usually with a mutual fund, you're so remote from those companies that there really is almost no causal relationship. And so it's very, very limited there. And so then the question is your saving for retirement and preparing for that proportionate to that evil that you are in a sort of minimal sense related to? And to me, it sounds like it's so remote that it's almost negligible. It's not even clear how you buying the mutual fund, especially at the levels we would typically do that at, would be supporting them or contributing to them achieving those evil ends. Because you buying into a mutual fund probably will not have any impact on the company, causing their prices to go up or anything. But it does allow you to save for retirement and then be able to achieve those good ends. When we get into stocks, though, it kind of changes a little bit, because you have those additional rights to make proposals and to be involved. Again, though, the difference is that with stocks, you're more than likely going to be an extreme minority investor. And so you will have very little power to actually influence the company and actually affect change. And so that causal relationship is, again, very limited. Like, you're not going to be supporting that end, but you're also not going to be able to stop it, typically. However, because you have those rights, I think you also do have a responsibility. So if you are going to own stocks, you should really be involved in that company. And that's something the bishops have in their own investment guidelines, is that they make this consideration of cooperation with evil and double effect, but they say, no, we need to be involved with these companies and potentially move towards change. And some bishops do that. But if you don't have the time or knowledge or sophistication to be able to do that, to make proposals or be involved in these meetings, then maybe that's something you shouldn't do. Maybe you shouldn't try to own stocks in companies. That is a potential consideration. Now, there are, because of the vast universe of companies, there may be companies where you can buy stocks and they're, not committed to some sort of grave evil, and you can be a minority, an extreme minority share owner and take advantage of that. And you don't necessarily need to worry about making proposals because they're doing good things anyway. So there's those type of considerations. Now with bonds, the interesting thing is that if you buy a new issue, you are directly supporting that company. That money goes directly to the company. This would be similar for an IPO, so an initial public offering with stocks. Typically, most people are, most investors, the average person, I don't think is going to be involved in an IPO. But with a bond, you can go out there, and some companies will issue bonds as low as $1,000, and you can do that, and that money will go and support the company. And so that is a more direct consideration of you causally supporting what they're trying to accomplish. And so then that proximity that we have in legitimate cooperation becomes closer, because you're helping them actually accomplish that end. And so that becomes a bigger issue. Now, you giving them $1,000 or not, it may not have a huge impact, but it is closer. And so then whether you have to invest in this particular company to achieve your good ends, it becomes a little bit more less clear. Now, buying a bond from someone else, though, so the money has already gone to the company and you're just buying that bond from someone else, that becomes a little less morally problematic, because you're not contributing to that company, you're not supporting them achieving that goal or anything like that. And so there's that more distant cooperation. In fact, I'm not even sure what sort of cooperation there would be. I've been trying to think about this, and it's just like owning the bond, not having actually given the money to the company. I'm not sure what sort of support that gives to the company and how it causally impacts it. Now, part of the moral consideration of all this is also potentially the scandal that goes into it. So if people find out that you're investing in evil companies, it can cause a scandal in people starting to think, it's just these companies are okay and what they're doing is okay. So there is those type of considerations as well. But again, the vast array of securities allows us to kind of potentially consider companies that are not committed to grave evils. So that requires some research, but it's research well made. Now, let's say at the end of the day, so you are limited to a 401k. Your options are extremely limited. So you only have a handful of mutual fund accounts that you can invest in. Okay. And so your question then is, well, should I invest in this 401k or not? And you've decided prudentially, I can't invest in these companies. And it's important to realize that simply because this is a prudential question doesn't get you off the hook. So just because it's not intrinsically evil doesn't mean you're in the clear. You need to make real moral considerations. So if you come to that conclusion where you're like, well, I don't think I have a good reason to invest in these mutual funds which are, investing in these gravely evil companies. So what do? So you can still invest in the 401k for the reason that pretty much every 401k is going to have something called a money market account. And what a money market account or fund, like all it's going to do is keep your money at a dollar's value. So it might hurt you with inflation. There might also be some stable value funds that are invested in, some really low yield treasuries, for example. And so you could retain at least your purchasing power over time. And so even there, you can gain the advantage of, that employer match, while also maybe even retaining your value, or just retaining those dollars. And that's a legitimate solution. I think that is a perfectly moral option. I think it's the least ambiguously licit option. So you could at least do that, and at least get that employer match, and so you can at least grow those sort of dollars and sort of double your money at least in that way. So I think those are some of the moral considerations, and I think so. To kind of summarize, so at a minimum, you should be able to at least kind of get that 401k match from your employer and not be involved with the evil doings of any company. The next thing is the wide variety of investments allows you to be involved in companies that are not committed to some grave evil or not wrapped up in some grave evil. So that's always there. The next thing is that if you are wrapped up in those companies, there are legitimate moral considerations of how you could stay there. And this, again, is what the bishops have in their own guidelines. But you need to take into account, what are your rights and obligations, given the sort of things that you have. And I think those are kind of the main considerations, taking into account those different things. So that kind of wraps it up. A little longer episode. Thanks for listening. If you have any comments, questions, or thoughts, leave them below. I'm really interested in this. I'm still trying to work it out. So yeah, thank you for listening, and have a great day.